Awesome. Thanks, everybody. Kris Hansen. I'm the CTO at Sagard Holdings. I'm also the founder of Synctera, which is a banking-as-a-service company, which is fantastic because we're talking about banking as a service. I can see my colleagues back there. Before Synctera, I was with Coho Financial. I was a CTO at Coho, and before that, I did a stint with Royal Bank, and I was the chief architect at ATB Financial, where we blew up the bank and replaced all the software in 4 years. That was a tough one. And I'll pass it on to Stephen.
Stephen Murphy. I'm the group head at Canadian Western Bank for Commercial, Personal, and Wealth. So Canadian Western Bank is an Edmonton-based Charter One bank that is essentially, our focus is around the business owner and creating a boutique around the business owner. And what I do is we have essentially our network of, we don't really have branches. They're more, like private banking boutiques, wrapping the personal and wealth needs around that business owner. And then I also run our specialized lending businesses and our wealth management business. So we're a full service bank, but we also do work with other financial partners as well to enable them. And on both ends, we work with companies where, for example, we would provide their funding in their fintech and a lending business, but we're also a receiver where we use Brim for our credit cards, for example. So we're on kind of both ends of the value chain.
Thank you. Good afternoon, everybody. I'm Noah Buchman, co-founder, president, chief revenue officer of Propel Holdings. Propel is a mission-based fintech based here in Canada that's laser focused on credit inclusion, and we facilitate access to credit via our proprietary AI-powered technology platform. And we fuse the best of finance and technology together to enable that mission of credit inclusion.
Awesome. So banking as a service, this is a kind of a blanket term. It's an acronym. What does it really mean? What does it all entail? So, really what we're talking about is partnership banking. Typically, there's a decoupling of the underlying chartered financial institution, which has the underlying ledger or a ledger that the regulators look at. There's some kind of go-to-market entity that has the face or the brand in front of the customer. That customer could be a consumer, could be a business, and then there's like some stuff that's needed in the middle. And all in all, it creates this capability that allows for APIs, typically from the bank side, to be extended into a go-to-market entity. The end experience is that consumers are able to see financial services products in places that they aren't used to seeing them. And so maybe we can just start with a bit of like what's the genesis of banking as a service? What have been your kind of experiences with it, and why should we care about it?
Sure. Yeah, I'll start off. In our mind, we view banking as a service as the umbrella term, really for the distribution of core banking services and products that are distributed from third parties, either from fintechs direct to consumer or fintechs to other fintechs and then out. Propel has, as the umbrella parent company, has a number of partnerships, and we have 4 different banks on our platform in the US. Canada's ripe for the opportunity, and the one we focus on specifically is an arm of banking as a service, which is the lending aspect. And we have focused exclusively on lending. So in 4 different structures with different banks and different programs, we ensure that consumers all throughout the credit spectrum can gain access to credit in lending by utilizing the sponsorship banks or the white label banks product in market. So to answer the question on the evolution of it, what we've done and what you can see is really where the fintech bank partnership started, which was in a sponsorship model. And we see that with some of them with a co-branding kind of between the fintech and the bank. That's also then evolved over into white labeling. We then have their products and services embedded, and also further direction where it's going, which we're working on. Both sides of the border happen to then to be on the customization. So instead of a one size fits all or one generic product across the board, a company can have a tailored direct product that's specific to what their needs is. And so that's why we work with either other fintechs or other banks to have that customization embedded in their markets.
And maybe from our perspective, so, we're a full bank competing against Goliath competitors in our marketplace who have, depending on the segment, like 95% market share. And so, we've picked a lane around the business owner and we said, okay, we can compete with the big banks by choosing a segment and doing it better than they can do it, because not that they're not good at it, it's just that they can't be excellent at everything and they can't stitch their organization together and provide an experience the way that we can through our focus. And so also, though, in trying to keep up and compete and be competitive with them, we can't do everything. We can't build everything. So, we become, it becomes important for us to build a technology stack that we can work in with other providers to get best in class products and services around our offering, because we can't do it all ourselves. And so that's our strategy. And we're always looking for things of how can we add value for business owners in particular. And then on the other side, we, as a business, we actually within particularly our lending businesses, we support a number of other companies who have business models, our fintechs or other companies who do lending, enterprises do point of sale lending or whatever. And so we're also on that side. The tricky part for us has been, we've had companies come to us many times wanting, access to the rails, like be our white label provider. I think that's the trickier part of banking as a service, is how to make that work. When, you've got somebody who, doesn't have necessarily one narrow slot, but they're like, how can I be a bank without being a bank?
Yeah, I think that's a really good point. And, we're seeing a very kind of public example of what can happen if that goes wrong in the U.S. How do you think that regulators are looking at this in Canada and the U.S.? For those of you that are, not maybe watching the Banking as a Service news, there's a company called Synapse, which is a banking as a service provider in the U.S. that's going through bankruptcy, and end consumer funds are getting frozen and regulators are asking questions. So what do you think that's going to mean in the regulatory space?
Yeah. So regulators say things like, so FCAC just took over open banking. And, the view is that they don't want to bubble wrap the consumer. So it's not about risk elimination completely, but at the same time, they have responsibilities for order and protection in the market. And so they would look at just a mess and say, well, we don't want any part of that mess. So I think, there's an interest in expand. I think they look at the higher priority is around consumer choice. But that doesn't mean you just let anything go. And you look at something that's a heroic mess as that one. They're focused on not necessarily preventing that a company fails. And we're not used to financial failures in Canada that much. It happens all the time in the US. They're more about speed to resolution. So to your point, if you've got clients locked up and they can't get their cash and it's in court, who's got the cash and stuff, that's terrible. And so that's the kind of thing that they want to think about, how quickly does this resolve? How does that work through? But everything that they look at, from what you can't have is that you expand consumer choice and you just punt all the protections around AML and everything else. There's very little appetite for that.
I think the way we approach it is two main buckets. The first one is the focus on third-party vendor management. That is by far and away receiving the most amount of scrutiny from the regulators. And the company, as well as the bank, which will dovetail into my second point after, must have a culture of compliance. So that has to sit right at the top of what happens in any bank fintech partnership. if you don't have a culture of compliance and if you're not laser focused on third-party vendor management, it's very easy then you could slip in any type of audit. The banks have to have all of the information at their fingertips. So we're seeing an increased focus both from the FDIC and the OCC. We have partnerships with both regulators in the US, even though we're based here in Canada, of making sure that their banks have not just full oversight of the program, that's easy to paper, but it's all ensuring that any piece of information is speed for them to be able to respond. And in order for them to have speed to be able to respond, the fintech in the banking as a service partnership has to have their shop in order, and it has to be squeaky clean. The second part on it, which may be related, and it could actually, there could be byproducts of what's happening in the situation you referenced, Kris, is you have to understand who your partner is and who their partners are. You can't just take a bank because they're a bank, and a bank can't just take a fintech because they're a fintech, and you have this wonderful partnership. Nuh-uh. If the bank or the fintech has some deep-rooted issues in it, it could have a cascading effect. So what the regulators are then doing is that if a bank, for example, has a bad actor in their portfolio, well, that's going to spill over. As good as you may be, if your bank is working with other poor partners or poor actors that aren't compliant or have other issues, you can have a serious impact, detrimental to your program, and vice versa. The banks as well, from their regulators, if their fintechs run into issues as well, that could then cascade, and the scrutiny could, in some cases, become unbearable. And we've seen it in the U.S. as well with a lot of banks where one little thing, even from years ago, where there is a slip up, they don't get let off the hook, even if it's been solved, and it can be an overhang for years. They could limit partnerships, they could limit the ability to grow, they could freeze, it could really make life miserable. So looping back to the first point, third-party vendor management, culture of compliance sitting right at the top, that's what's critically important.
I think that's exactly it. Like, the bank has to pay attention, the fintech has to pay attention, everybody has to, do their part. Now, what about margins? What does it mean to do partnership banking as a service from a margin perspective? Is there enough margin to sort of go around with all the players?
Yeah, I think it's one of the challenges that's shaking out in the industry. When certain business models are simple, like lending is simple, and if you can lend at enough yield, there's enough money to go around. And so that's why Stephen Smith was talking before about segments that are spaces where the yields are higher, there's room, and smaller players can gather funding and make that work. If you've got somebody who's trying to compete with the Royal Bank on prime flat lending, like, good luck with that. Like, good luck. And where are you going to get the money? Like, equity is too expensive, and I'm not giving it to you. So, like, that doesn't work. And so lending can work if there's enough margin. It's when you get into other services, like somebody wants to do deposit taking, there's not enough money to, like, typically they're like, well, I'll pay you a fee to do all the stuff on the accounts. Well, no, I'm not doing that. Like, I want the deposit. That's where the money is, and there's not enough to share. And then if you've got a really cool idea, you've got two options. One is the client has to pay for it, and people generally don't like paying for fees for financial services. Or it has to be so sexy that they'll switch all of their banking for it. Otherwise, I don't get your business model. And so there's got to be enough profit to go around to make partnerships work. And certain things work well, and other things, it's still, for me, a little bit unclear as to where the model is, because growing revenue without a path to profitability and adding clients without a path to profitability, like, it just doesn't go anywhere eventually, unless a big bank buys you out because it's not a lot of money to them and they kind of go, this makes a kind of a sexy offering for us. But generally speaking, if it's not sexy enough to make somebody switch, or that it earns its own fees, what good is it?
Kris, I'm going to loop this back to your question about evolution and where things are going. So typically, if executed well, there's margin being able to made if you're a bank or related in lending and wealth management, typically if executed well. There are other services under the umbrella of banking as a service. But those are the two ones typically where the money's made, at least from a margin standpoint. We have focused exclusively on lending, even though there's been a lot of tempting either M&A or other partnerships or other stuff to do outside of it. But, you know, Propel's been profitable since 2015 because we have focused exclusively on the lending aspect, because that really is where you can be profitable. The evolution part of it is that what we're seeing now is that a lot of other fintechs who grew tremendous businesses in terms of the scale and the number of users, who focused on either other free products or related, they now are looking at lending. They have to augment their suite of offering with lending because they need to actually start making money. Over the past decade, and again, we received a lot of pressure, and me particularly in my role, is why aren't you growing faster? Why don't you do more? And the reason is because it wasn't profitable growth, so that's not how we were oriented. And a lot of business models were predicated on continuously raising capital. I have a lot of friends who built tremendous fintech businesses, but what we've seen over the last year and a half, almost 2 years now, is that model. And again, you know, very interesting, you know, for you know, maybe a response or rebuttal where you sit in terms on the, either on the private equity or the venture capital or other side of it, is a lot of raises, right? And they were built and they had great scale. Now, at least what we've seen is a shift towards that, and they're coming to us. So I would, you know, speak to anybody who's built a fintech that is looking to have a lending offering. You need to then match and be with an expert, and that's what we do, because that's where you're going to find the margin.
Yeah, I mean, I would say fundraising is, you know, an end to a goal. The goal is to have a real sustainable business. I mean, nobody wants to fundraise forever. But, you know, as firms get into lending, you know, coming from deposit taking, coming from card issuing, it's a more sophisticated business. Like, you know, I've heard it's very easy to lend money. It's actually hard to get it back.
Spot on. And truer words have never been spoken. Yeah.
So, but like, is that something like, can these firms get into that business kind of eyes open with the right guardrails, with the right controls, so that they can do that business well?
They can with the right partner. And that is this late stage of, not late stage, but the latest stage of banking as a service where it's gone to. So if you take a company that has an expertise in that area, where today you can have bank to fintech to consumer. You can also have bank to fintech to consumer, and a fintech or another company that wants to have an embedded lending product can work with a fintech or a company that has an expertise in lending, like Propel does. And though we offer it direct to consumer today through our bank partners, another fintech can partner with Propel, and they can then offer a credit product to their own members or to their consumer market via the expertise that we have. And there's many different ways that it can be structured and who takes the balance sheet risk and related. But if they're looking specifically now in order to just add additional revenue per head or revenue per user that they have, because they've done a phenomenal job of being able to acquire customers for their initial product or initial product suite, it can be done in a partnership with somebody that has that banking as a service or lending as a service relationship.
Yeah, and like Noah and I were talking, like we are developing, you know, historically we've been more of a mid-market business owner boutique, but we're building a virtual small business channel. And, you know, we were having the conversation of, like I started, it's like, well, do we or enterprise-wide have unsecured small business lending experience or modeling experience? Like, we just don't have the background. So it's possible that we would partner and actually have somebody do that with us, and that we're doing the bank accounts and then other products and services that we'd bring would probably be a lot through partnerships. And so there's a lot of this back and forth opportunity, but even as a bank, a large business focused bank, I might not even do that segment of lending myself. I might leverage a partner.
Yeah, that's a good point around focus. Like when you think about this space and banking as a service and partnerships, is it evolving to a more focused business where, you know, I think in the early days you saw neobanks and there was a bank for pet owners and there's a bank for this and a bank for that. Like, is that now kind of evolving into a much more focused play both on the bank side and on the go-to-market side?
Yeah, I mean, if you pick a segment and you you nail it, I think the neobank piece can work. If you actually like created the bank for pet owners, like that doesn't even like have to be cat owners or something. It'd have to be super specific, I think, to work. And that it's just so much value and so tailored that they bring their whole financial relationship to you. That I get. Trying to be a mini Royal Bank, I do not get. I just don't get it. And like we have all the products and services of Royal Bank, but we're not trying to be mini Royal Bank. And particularly if you're in the consumer space, good luck with that. And so I think increasingly you got to pick a lane. You got to pick a lane, be hyper-focused, know what your value proposition is, and how amongst your partnerships you all make money. Because you've got to figure out everybody's got to have a value proposition there. And, you know, we find late in a lot of conversations that people are thinking they have a value proposition. It's like, no, I don't think you worked us into that. And so the math actually doesn't work. And so I think you got to pick how you're winning and what's the conversion into profitability.
We're definitely seeing the evolution into that as well. And everybody knows after this kind of, in some ways, crazy or rapid development of too many apps on the phone, right? You have an app for this, an app for that, app for that. In a lending as a service partnership that we have with a large bank in the US called Pathward, you don't see Propel or anything. It's actually fully white labeled, but it goes a step further into evolving to where it's going now. So instead of Pathward having a lending app giving out to their partners, what they've done is they go to their partner network. So they have all the payments and tax partners, and they have members, and they want to have their bank's lending product offered to their partners' customers. So what they're doing now in the program with us is, and we're the tech side, right? We're the fintech, is we're embedding the product and the offering in the neobank, in the payment or the tax company, whichever it is they have across the board, the Pathward lending product in the partner's app. So the neobank is now can have a pop-up, they can have a notification, they can send out an SMS within their own environment. They can keep it in their environment, and now they have a lending product through a bank that we do all the powering for. And that's the powerful part of lending as a service. And now it doesn't need to be its own separate standalone. It doesn't need to be a specific lending product where you now have to have an additional app on your phone or another website. Companies, fintechs, neobanks can keep everything in their environment now through a banking as a service relationship if it's structured correctly.
Yeah, I can see that. That makes a lot of sense to me. It seems to me like when I think about banking as a service, kind of a core underlying sort of element of it is really just partnership. Like really, this is nothing really new. These are partnerships, right? Well, we've been doing partnerships in banking probably since the beginning of banking. But like, what is it about partnerships and getting that right? Or how do you get that partnership right to be able to do these banking as a service deals correctly?
I can only speak for us, and as a company that's steadfast in ensuring we have different programs and offerings around credit inclusion, our banks have to have that same type of focus and have to be oriented that way. It's not just a commercial deal, because a lot of ways if it's just commercial, it's going to be service, but it won't really actually develop. And you won't actually have their teams, their arms are in too many areas. But if there's a fundamental belief and you have alignment of either values of the organizations or strategic alignment on what the fintech wants to do and the bank wants to do, that's then a marriage for a successful partnership. Not just something that's transactional. One will then eventually drop the other, or they won't actually reach their potential.
Yeah, and I think, partnerships, you're bringing other people into your client experience. So ultimately, you got to make sure that you vet them around stability and what they're going to bring to your client experience. And so, I had the experience that we partnered with a fintech and they ran into trouble. Well, we actually had a large proportion of our clients on their product at that point, and now they're in trouble. Like, what are we going to do if they have service disruptions or they can't back up the commitment that we've now made them vital to our clients? And then they were bought out of trouble by a company who had anti-money laundering challenges. It's like, this is worse. This is getting worse. And so, so there was no question they had the best product at the time, and they weren't the right partner. They weren't the right choice for us. And so for us, it's like we're betting our client relationship, and everything has to create a winning environment for us, because I'm going up against Royal Bank and I can't take any weak links, and I sure can't take the distraction and drama of somebody who's got operational challenges.
Just going back to that one more point, Kris, is you could put the other at risk. So that has to be vetted, right? Who is the bank working with? Who is the fintech working with? What are their practices? Do they have that culture of compliance? Have they run into trouble? Has either had any type of consent order, has either been fined? Because that will then permeate throughout. And if you get into this situation, that's going to severely damage the relationship. So you got to do your diligence both ways, two-way street.
Yeah, I really agree with that. Like I've been involved in a few partnerships along the way. What I typically counsel people is, like, in financial services, you're going to have bad days. So I remember the asset-backed commercial paper crisis in '08. I've had various operational issues. Like sometimes the payments don't flow, things don't happen, something is broken. Who do you want to have those bad days with? And you want to make sure you've got the right partnership, the right relationship, so that you can have the good days, but also get through the bad days and come out the other end intact.
Yeah, I think that's, to me, financial services isn't about risk elimination, but it is about resiliency. And so that matters into how you frame and look through your partners.
Yeah, and certainly integrity is up there, and third-party risk management and everything else. How are we doing on time? We got a bit of time left. I was hoping to go to the floor and kind of run around a little bit. You guys can give me my workout. Happy to take some questions from the floor if we have some questions. Anybody have any? Oh, there's one in the back here. Do the gauntlet. Okay. Go ahead, Doug.
How do you view the alternative, which is the bank becomes a banking as a service, so it's not a third-party player between the two, the bank, fintech to customer? What do you?
Yeah, I like that question. So the bank becomes a provider. The bank gets the tech that they need. They get the APIs or whatever else they need to do it. What happens then?
I'm happy. Yeah, both. Seen it both ways.
I should probably think about whether I should say what I was going to say. So, I guess it's not clear to me that the big banks would see that as a business model. So I'd say if you think that the big banks, maybe. I mean, for us, it's about focus. Like, it's hard for me to imagine. Like, you almost need a pure play, right? Like, you need someone who has a banking license, and this is all they do. They are a facilitator of other FIs. For us, there's got to be some kind of synergy, because it's kind of like if we're gonna, there's certain things that are work for us, but it's not like this is a complete business line for us. So, we don't have a lot of players like that. And, we talked about the challenges down in the States. And so, and then the regulatory burden makes that quite challenging, I think. But I just, I think it would be something like that, because I just don't see the big banks doing that.
And I think a lot of, in our experience, have tried, and it comes down to the sage-old advice: if it's not your core competency or your wheelhouse, you outsource it, or you have some sort of partnership. And the speed of technological development now, digital acquisition. So if you go through banking as a service, and we'll just use the arm for lending as a service, customer acquisition, huge part, be able to do it profitably with pure digital channels. Servicing, the technology aspect of it, which also is the statement of record, the loan management system, the operational component, customer service, recoveries, collection, QA, data, business intelligence. Like, these are all the types of services that the bank must be an expert in order to offer a successful skip of a bank fintech partnership. And when we were researching the space starting in the beginning of 2011, that's exactly what we identified. It's not the bank's core competency. That's why we developed all those types of services, and banks can then, through a simple one-hook API, come in, and then that can be spread out to many customers, partners, etc. Can get very complex for a bank, especially if the bank doesn't have, or if they do have a branch network. That's completely different than if they were pure online. So it's, you know, it's a process, but either typically if the bank's large enough, they would buy the fintech, but as we've seen naturally, it's the partnership in banking as a service.
Yeah, I mean, I've seen a lot of banks, you know, want to do this, but when they really look at it, there's a real commitment to tech that you have to get right, and you have to stick with it. And you know, I designed a great API, great payments API for one of the big banks back in 2012 that I think was, you know, really well designed. They were fantastic to work with. They stuck it on the shelf and didn't release it. You know, they would have been in the banking as a service business, but they decided not to do that. So it's not just the ability to spend and the ability to build, it's the ability to kind of have that strategy and stick with it and get it launched.
I'd just add too, like, this is a bit of, you know, if an enterprise is choosing a business strategy, it's got to make all those investments. I think the presumption is, well, if you're a large financial institution, you made all those investments because you have to, because you're a bank, leverage it at the side and white label it, and it's just extra revenue. But like we talked about, like, that's a lot to have at the side, and to put all that effort to vet what those other partners are doing and everything to use your rails when you're going to wear the problem. And just look at the issue of a very large bank who might get fined $2 billion. Like, you got to do a lot to make $2 billion. So that hurts if you end up getting fined that much. And so, like, I think for us, like, we're like, okay, to do the investments, to do all that, like, I'd rather hog the puck. I'd rather invest that in my core business and do that. So why would I do it on the side to facilitate just getting clips of fees? I'd rather actually take in deposits and lend out money and make the full margin.
Great question.
But with a Brim or somebody like that, they're perfectly complementary because they have a lane that works with us, that complements us. And then they actually, we actually own part of our credit portfolios, and some of it they do and they hold, but they originate all and it's invisible to the client. And so that's where it's a perfectly, but if they were trying to be a neobank, it would be a weirder partnership.
But that's part of the advantage too, is that like a partner can just sort of take certain concerns off of your books, so you can just focus on other things. That makes a lot of sense. Any other questions from the floor? Anything else? Awesome. Noah, Stephen, thank you so much for coming out.
Kris,
thanks everybody for joining us.
Thank you.